SIP. So this is a 5 days event. So today is the first day you are learning about the most simplified way to understand the option delta. Tomorrow we have a session on theta, Vega, and on 9th we have a advanced concept on IV ranking, IV rank and IV percentile and how to use those things in trading. In the last program I will be telling the option strategy adjustments, how you can do option strategy adjustment that you learn. So just visit our website under seminar link, you will find this registration links. Please do register there so that you can participate on those events. So today the first event on simplified way to understand option delta. So what is this option delta says and why we need that? And the aim of the program is to use the complex option delta in the most simplified way. As a layman, as a small trader, as a non-mathematical person, how I can utilize this delta for my benefit, how I can take benefit of this option delta, how it is going to help me for projecting my profit and losses in option or option premium, that you are going to learn. So many other factors can enhance the delta's performance. However, most simplified way how you can understand from option delta, that I am going to tell. In our website you will find many other delta neutral option strategies, some advanced concepts and all. So by definition what it says? By definition, option delta says that rate of change of option premium with respect to underlying asset price. So with respect to underlying asset price, how the option premiums can change. Say if 10,700 call option 10,700 call option of Nifty, if it is trading at 142 rupees now and its delta translate to 0.45, if this is the delta, this says each 1 rupee changes here, each 1 rupee changes in the Nifty, each 1 rupee changes in the Nifty will bring 45 paisa changes in the call option premium. So this is what it says. So how we can utilize these things for our benefit, that I am going to explain. So I have given some example. We will take some back testing also, we will do some of the back testing also we will do. So Nifty is currently at 10,638. I have taken 10,650 call option and it is trading at 126. If this is the thing I have taken, and delta also I have calculated. This delta calculation I will show you in our web calculator. So this is the delta we got. So forget about formula, you got the delta. Now from this information I have to calculate the 650 call option premium when Nifty is at 10,580 or 10,660. Currently it is at 10,638. So if I am thinking that yes, Nifty can go up by 22 points or can fall by 58 points, so what will be my option premium? So based on this delta, I have just given it here. To attain this 10,660, Nifty has to move by 22 points up, and to attain this 10,580, Nifty must go down by 58 points. This is a very simple calculation. Currently you are here. To achieve 10,580, it has to fall by 58 points. To achieve 10,660, it has to go up by 22 points. This is just a layman's language I have given. So this 660, 10,660 or 580 is not any technical resistance and support. Don't correlate with that. So it is just 2 price points I have taken. Currently I am at 10,638. I want to achieve 10,660 or I want to achieve 10,580. So this many points I have to move up to achieve the up target, and 58 points I have to fall down to achieve the down target. So at these points, what will be the premium of my call option? So call option currently at 126, it has a delta of 0.49. So this information I have. So to use the delta, what I have to do, if it has to go to 10,660, then the call option has to go up by 10 rupees 85 paisa. How it is? So you can say the 126 added with 0.49325, the delta, multiplied with the 22. So this factor 0.49325 multiplied with the 22, this comes to 10 rupees 85 paisa. This comes to 10 rupees 85 paisa. If I add it, it is coming to 136.85. So this is just a projection. In real market we'll experience whether this projection really work or not. That is, we have to experience in the market. We need to do some back testing, then only we can able to know that. So coming to this downside, if it is falling to 10,580, then 58 points it has to fall. So same delta I am multiplying with minus 58, 55 point it has to fall. So it is getting 28.68. So the projected price will be 97.35. So you have understood till this point how to project the option premium using delta. This is what I explained. You have a delta in hand, you have an option premium in hand, you have the last traded price of the underlying asset. Now you have projected the premium at a upper target point, you have projected a premium at a down target point. Whether this simple formula works in the real market. This small calculation, whether it is, how far it is true, whether it really works or not. So I am just going, though this slide I have made it yesterday. So now I am going to a real-time example, the backtesting example. So backtesting example and the real-time example I am taking. So I am going to our web calculator, smartfinance.com. If you just go to the calculator section, so if you want to go to the calculator section, you will be getting intraday option trade software here. The 12th link will be intraday option trade software. So this tool you will be having. So I am taking a real-time estimation of the delta to demonstrate how far these calculations are true. So today, if you just look into the NSE site, so how far we have to take the true data. So I'm just going to NSEindia.com. I just want to find out some of the prices. So for that, for my delta calculations and other things. So I'm just going to the NSE site. I am going to the equity derivatives. I am putting the Nifty. So the Nifty data I want. So the Nifty data I want. What price it has opened up? So today the Nifty has opened at 10,645. 10,645. So these are the same thing I have put it here. So Nifty has opened at 10,645. 10,700 call option has opened at 107 rupees and 10 paisa. Then I have to, Nifty has today closed at 10,732. Call also closed at 142. So these things I need to calculate. So I just took this options calculator and I'm just going to feed the same values here. 10,645. I opened. I have 24 days till expiry. 26th days are here. 26 days are there. So 23rd day, 23 days you can take. 23 days left till expiry. 10,700 call option. And that call option at what price it has opened, that is also very important for us. So here I am going to the option chain. I am going to the option chain. I want the option, from the option chain data, I want 10,700 call option. So this is the price of 10,700 call option. It has opened at 107 rupees and 5 paisa. So this is what the opening. Nifty opening you found out the call option opening. Our objective is to back test whether our delta method, what I have told, it works or not. 107.10. With the call option, we hit the button. So here all data has come. Everything, I'll not look into any of the parameter except delta. So many calculations has come. Delta has a formula. It has given you calculation 0.44133. So this is what you got. So 0.44133. This is the delta. So this also I have put it in the slide. So this is the opening of option, this is the opening of the future, and this is the 44133 is the delta. So by day end, Nifty is closing at 10,731.95. So how many points it has moved from opening to the closing? So if you just subtract 10,732 minus 10,645, you get 86.95. 86.95. I am multiplying that with the delta what I have calculated based on the morning data. It gives me 38.37. I am adding that with the 107. I am getting 145 rupees and 47%. This is what as per the delta I have calculated. However, in real market where the call option has closed 142. So very close, near some 2 to 3 rupees it has less, it has triggered. However, very close values I got. So why this 3 rupees difference is there, that also I will justify. See another one example also. Same way I have taken 10,700 put option. Opening was 166 rupees and 10 paisa. Delta was 0.53941. So delta is negative for both. So same way 86 point movement multiplied with 0.53941. So once the price of the underlying asset move up, the put option has to fall down. So here 46.90 added with 166, it gives you 119 rupees 20 paisa. Actual happened 115 rupees 50 paisa closing. So there is also 3 to 4 rupees difference, 3 rupees 80 paisa difference has come. However, this calculation was very close near to your delta. This calculation is very close near to your delta estimate. So this is what you have got based on delta. You have projected something in market, something has happened, and the market price and your projections or your calculated price compared with the market price, it is having a close relationship, but it is not exact. It is just close near values, but not exact. Why it happens so? Why it has not become exact? I have calculated. Then what stopped the price? Where went wrong with my calculation that it has not achieved the exact price? So because I have taken the delta as a constant factor, morning it has opened, I have taken the morning opening delta. So it is not a dynamic delta. So I made the delta as a static. That is one of the factor which is just little bit of I missed the calculation and the real values. Whatever the real values it has happened, and whatever I have calculated it has just missed by few points because my delta was not dynamic. It was not dynamic. It is a constant. I have just morning opening price has happened, I have taken. And once the option price is not only dependent on the delta, it has also some impact on Vega and Theta, which you are going to learn in the next two sessions. So this Vega and Theta has not participated in the option price projection. So this is also one of the reasons. So these two reasons made my calculation to miss by 2 to 3 rupees in terms of the premium. So once I add that things, I'll further improve my calculation to a near value. So this is how you can make the deltas use. Second, something something, so something on more on the delta. So some more facts about the delta. Delta of a call option varies between 0 to +1. Maximum it can go to +1. Delta of a put option varies between 0 to -1. And delta of a future is always 1. So these are the facts about the delta. And delta of call option increases if the underlying prices goes up. If the price of the underlying asset, whenever you are taking Nifty call option, Nifty is the underlying asset. When you are taking TCS call option, TCS is the underlying asset. So call option delta will start from 1 point and it will go on increasing to the maximum of 1 if the prices goes up. And same way, the call option delta also will fall and come to minimum of 0 once the prices are coming down. Put option increases once the, or decreases, you can say it is a negative number, so it decreases if the underlying price goes down, and it increases to 0 so once the underlying price is going up. So this is what the nature of the delta. So now there are 2-3 reasons I need to justify for our software. Why our software? Many of you are the buyers, many of you are using our software also. So what way our software helps you to improve this particular option calculations? So all our delta calculations are real time and it is exact as per the formula. So many used to ask me whether this particular delta calculation, whether this, so whether this calculation is true to certain extent, or it is the delta projections whatever we are making, whether that the delta projections is correct, or based on this delta whatever the options we have, option premium we are calculating, whether it is correct. For that the calculation of delta must be correct. So if you get a correct delta, then you can able to estimate the correct premium. If the calculation of delta itself is wrong, if the delta calculation given by your software is wrong, then the option premium calculation won't come correct. So whenever you look into our software, and many of you are using our software, so whether it is a one standard deviation software or smart IT software, so if you just look into that, how our delta calculations are being given there, that is a very important factor you need to look into in our software. So many of you, though you will be using the software, but that factor of delta, vega, theta or option Greeks, many have not given any importance. So that part I'll just demonstrate here. So if you are going for the options and I'm going for the index future, I'm going for the Nifty, I have loaded the data, and any one call option I am just going to analyze. Say same 10,700 call option I am going to analyze. So you are getting the current delta. This is the 142.95. Current delta is 0.63.4. Once it moved by 6 to 7 point to target 1, delta also changes. Second target you achieve, delta further changes. Third target you achieve, delta further changes. So last target you achieve, delta further changes. So based on these changes of the delta, these premiums are being projected. So here too also you can find out once the prices are being falling down, the delta is also changing. It has currently, whenever you take currently one price is there, some delta is coming. Once the price moves, that delta is changing. So this is the dynamic delta you get here. Not only the dynamic delta, all our option Greeks is dynamic in nature. So all the option Greeks are in the dynamic in nature. So this is a fact which says that once the delta moves, your projection of the price is also will change. So when you take a constant delta, you are missing the target by 1 or 2 rupees or 3 rupees. Whenever you take a dynamic delta, your calculations of premium will be very close near to the target points. So this is what I used to show you, and I have also shown this thing. So it is a very simple tool. You can use it without any training or any assistance. So now coming to the position delta. So here the complexity of delta starts. One simple thing you have understood, now one complex thing let us say. So suppose if many of you are saying, and many of you also have sent me the email, if I am buying a call option and put option, so doesn't it will be definitely profitable. Many of you used to assume and say, and many of you used to send me an email also with the expectation that yes, if I am buying a call option and put option, I am neutral, so I'll be definitely making money. But in reality, when it happens, the reality, you are not making any money. You are losing the money. So money is lost. So many of you would have tried to buy a call option and put option and sit down for 3 to 5 days, and you found out that yes, it is becoming loss. Why it is not becoming profitable? What factors behind? So that also delta is going to help you. So suppose I have taken the same thing today's 10,700 call option and put option. Each one lot I am buying. Once again I repeat, I will go with your assumption. I am buying a call option and put option of 10,700 at the opening, market opening at 107 rupees and 10 paisa and 166 rupees and 10 paisa. Nifty opened at 10,645. Delta, as you have already calculated, so this is 0.44133 and 0.53941. So this is the delta we are getting. Price changes by 86.95. So based on that, we have already projected the call option will go to 145.47, but it has achieved 142 point something. Put option has to fall down to 119, but it has achieved to 115. So put option we have calculated 119 rupees 20 paisa. It has fallen down to 115. The reason also I have told you. 142.10 paisa it has achieved. We have expected 145. So both the places some 2 to 3 rupees we have moved. So now based on this, if I say at my buying price, both the premiums I have invested 273.10, and now based on my delta calculations, the premium is coming to 264.66. So it is coming to 0.84 rupees, 8 rupees 44 paisa loss. However, in actual case, my loss is 15 rupees. So 15 rupees and 10 paisa. So my estimated loss was 8 rupees 50 paisa only using delta, and actual happened 15 rupees and 10 paisa. What went wrong? Why it has happened like that? So you need to understand this factor through the delta. So the net delta of these two options was 0.9808 negative. So once you are buying a call option and put option, the net delta is the call option delta added with the put option delta was 0.09807 net delta. If I multiply it with the 86.95, I am getting the same loss of 8.52. So I have initiated a strategy having negative delta, so prices have moved up. So your strategy having a negative delta, if your strategy having a negative or the position is having a negative delta, then if the price goes up, so you will be making losses. Same way, if you have a positive delta, and prices has gone up, you will be making the profit. So profit and the inverse relation also you can see. If negative delta, prices has fallen down, then you will be making a profit. And if it is a positive delta and prices has fallen down, then you will be a loss. So this position delta says whenever the net position having some delta, from there itself you can able to estimate if the price move by 50 point, 10 point or 20 point, what will be my projected losses or gains. So this calculation validates when you have only one lot. One lot you buy, one lot put you buy, one lot call you buy. Or same way, two lot call you buy, one lot call you sell. So the net delta impacts a lot. You need to see that how much net delta I am keeping. Based on that, how much I am going to lose and how much I am going to gain. So this is also is going to help you in forming simple option strategies. You buy a call option or put option, no problem in that. Just estimate what is the net delta. And if the price is expected to move by 20 point or 30 point or 40 points, just multiply it with that and find out what is whether you are losing or you are gaining. So by this process also simple option strategies you can able to form. However, if you are using our option strategy tool, you get a delta scanner, you get a net delta analyzer, or you get a net Greek analyzer. So if you are using our option strategy tool, so how it helps? So I am going for user action strategy, and here say I am just going for stock future. I am loading the DGX and I am going for load this symbol and some amount of strategy I am going to form. Say I am selling one lot of future. I am buying a call option of 1900. Two lots I am buying. And I am selling a put option also along with that. Say I am selling 1825 put option. Sell one lot I am buying. I am going to hold for 3 to 5 days here. Calculate. So this gives you a projection of your profit and loss. See the net Greek analysis. So once you come here, you will get what is your net delta? 0.22. So this 0.22 is increasing. Once the price is going up, this 0.22 is increasing. And this 0.22 is again falling to 0.15, 0.12, 0.9. So further it is becoming negative here. So once it is going on falling, it impacts on the profit and loss. Once it is going up, it is also adding to your profitability. So individually each is components also if you want to analyze. Yes, I bought a call option. Now this point, it is going to 1965. So what will be the value of the call option as per delta? So for that also we have a Greek scanner. Take a Greek scanner. So 1900 call option, this is the delta currently. So based on this current delta, once the price move by 10 rupees, 20 rupees, 5 rupees, so what will be the value of the option you can able to project as I have told you. So if you just add on all these things, you will also get a close approximate value to this. However, this profit and loss projection also taken the account of your theta vega. So these two things also it has taken care of. This particular program is to understand the delta and how to use it in the most simplified way. I have calculated delta here. So I have given you some backtesting data, taken a call option and taken a call option and put option. In the morning when the market opened at 10,645, what was the premium? I calculated delta. Based on delta, day end, it was a 86.95 points of changes happened. Price gone up. Based on the delta, how much the premium should come and how much is really recorded. So it was close near to value and little bit of deviation is there. That is also because of the vega and theta factor. trend analysis is a second part or very essential while forming the positions or strategies. When there is a uptrend breakout, form positive delta strategies. When there is a downtrend breakout, form the negative delta strategies. And trend analysis you can follow by using any method. So now you can ask me if there is a uptrend breakout. You may ask me if there is a uptrend breakout, why should I form positive delta strategies? Why not positive delta strategy? Why not I will simply buy and just wait for the targets to achieve and get some profit out of that? Why I should go with this complex approach? If there is a uptrend breakout, trend breakout has given, then simply I can just buy into the stocks or future and keep a stop loss. Once it goes up, I will make money. Then what are the need of this delta delta? So here, once you use the option delta or option strategy or option position, they are along with the trend analysis. Along with the trend analysis, you are also doing money management. You are adding one more component to your trading strategy, which is money management. If you just look at the trend and enter to a counter for a buy or sell with a stop loss, you do not have any money management. You just go with one leg to run and win one marathon race. So think you have only one leg to run and win one marathon race, and you have two legs to run and win one marathon race. So which one will be easy for you? So this is the difference, or this is the most appropriate difference I can tell you for an option strategic trade and for a plain trade. So this is a free tool we have given, real-time option calculator. So here you can calculate and test how far our delta calculations are true. And if you wish to get our products, options, we have fantastic products. We have an option strategy software which I have demonstrated. We have intraday and positional option trading tool. Intraday tool I have demonstrated here in the one standard deviation concept. Intraday positional also you can take. So this cost you 8,500 plus tax. This cost you 5,900 including tax. And if you want to go with a comprehensive option course, it costs you 2,000. So based on your choice, you can book the course. So it is purely up to you. And all these courses is being explained with the most simplified way. It's just you have to divert your time and just go through the course a couple of times so that you can have any further query, you can call to these numbers or people will help you. So he has asked this question. He has, again I will go back to the questions. Some school use delta to calculate probability to be in the money. How far you are difference from this? So how far you are difference? I have not changed the delta formulae, Mr. Pandya VPG. I have already told you whatever formulas are there, I have not altered, manipulated, corrupted that formulas. I have just the conveying how you can utilize. Say 10,700 call option was 107, it was having a delta of 44 points. So pertaining to your question, if I go with the probability guesstimate, it says you have a 44% of chances, 44 multiply with 100, it has a 44 percentage of chances or 44 percentage of probability to be in the money. So it is just a other definition to explain the delta. It is not a new thing. Same delta you calculate. To be in the probability to be in the money, it is just a other definition of delta, nothing more than that. It is just a future programs are being designed to make you understand the most simplest way to use this option Greeks in your option premium calculation. This program is to make you the very basic understanding it will give you on the option Greeks, how to use them in the practical scenario. So big strategies and other things you can read from my book, or you can do some web search, or you can put a separate email if you are a buyer.